All right, let's look at Nuburu Inc. Since the U.S. markets are closed for the weekend, it being Saturday, October 25th, 2025, we are looking at Friday's closing data. The stock, ticker BURU, finished the session at 40 cents per share. That move is what's catching everyone's eye. It was up 0.059 on the day, a gain of 17.27%. And here is the immediate, critical disconnect. The expectation when you see a 17% gain on your screen, perhaps on the Robinhood app, is that this is a sign of health, a signal that the company's original business is recovering. The reality is that this move is almost entirely divorced from the company's original fundamentals. What we actually saw on Friday was a staggering 232.9 million shares change hands. Let me put that in perspective. This is a 40-cent stock that traded over 230 million shares. This is not a healthy institutional accumulation of a valuable asset. This is a speculative frenzy. This isn't a company recovering, it's a company that is fundamentally, completely, and perhaps desperately changing its entire identity. And day traders are piling in to gamble on the outcome. The original expectation of a high-tech laser company is dead. The new reality is that this is a publicly traded shell attempting a high-risk pivot into a completely different industry. Let's establish the common ground, the story that most long-term holders of Nuburu bought into. The original expectation was built on a very compelling narrative. Nuburu was a pioneer in blue laser technology. The pitch was that their specific wavelength of light was far superior for welding reflective metals like copper, which are notoriously difficult for traditional infrared lasers. The primary target market, and the one that got everyone excited, was the electric vehicle industry. Think of all the copper welding required inside an EV battery pack. Nuburu's tech was supposed to be the key to faster, cheaper, and better EV manufacturing. It was a story that fit perfectly alongside the meteoric rise of companies like Tesla. You'd buy Tesla stock, and then you'd buy the picks and shovels plays that supplied it, like Nuburu. This was the narrative that took the company public via a SPAC, and it's the narrative that many retail investors, perhaps using a self-investing account at Fidelity or SoFi Invest, are still clinging to. Now, let's challenge that narrative with the cold, hard reality from their own financial filings. That blue laser business has, for all practical purposes, failed. We have to be direct about this. If you look at their quarterly reports from earlier this year, the company reported revenue of zero. Not low revenue, zero. They also reported a default on their building lease, which resulted in their inventory and manufacturing equipment, the very assets needed to build those blue lasers, being written down to a net realizable value of zero. On top of this, their filings have contained the most serious warning a public company can issue, a going concern warning. This is accounting language for, we have substantial doubt about our ability to continue operating for the next 12 months. The original business is gone. The 17% pop you saw on Friday has absolutely nothing to do with EV battery welding. So, why in the world did 232 million shares trade, and why is the stock up? This is where the new speculative reality begins. With its original business in ashes, Nuburu has become a shell company. In September, it managed to raise $12 million in a public offering. This was a lifeline, but it wasn't to restart the laser business. Instead, the company has announced a transformation plan. It is using that cash and its public stock, BURU, as a currency to go on an acquisition spree in a completely unrelated field, defense and security. This 17% jump was directly triggered by news from just a few days ago, on October 22nd, that Nuburu is forming a strategic alliance and a controlling interest joint venture with a company called Maddox Defense, focused on drone technologies. The press release even threw out an anticipation of $100 million in annual revenue by the end of 2028. This comes on the heels of other announcements, an acquisition of a SaaS company called Orbit on October 7th, and the implementation of a new dual CEO structure to manage this transformation. This is the new expectation, that Nuburu is no longer a laser company, but is becoming a fast-growing defense tech conglomerate. The reality is that this is one of the highest risk strategies a public company can attempt. It is a roll-up strategy. They are bolting on small, likely pre-revenue or distressed private companies and hoping that the sum of the parts becomes worth something. That 100 million projection for 2028 is just that, a projection. It is not revenue, it is not profit. This company, which had only $111,000 in cash at the end of June, is now trying to manage a complex global M&A strategy in the highly regulated defense sector with the roughly $6 million it had left from its September offering. This is why the trading volume is so high. It's a binary bet. This is not the kind of stock that finds its way into Fidelity mutual funds or Schwab Intelligent portfolios. This is the kind of stock that traders on the Robinhood app and users of SoFi active investing platforms jump on, hoping to ride the wave of news and get out before the next dilutive offering, which is almost certainly coming. This is the cat and mouse game being played. This macroeconomic environment is also poison for a company like this. Interest rates remain elevated. This makes it incredibly expensive for a company with no revenue and a going concern warning to borrow. Their only option is to sell equity, but selling 40-cent stock is horrifically dilutive. They have to issue millions upon millions of new shares just to keep the lights on and fund these new acquisitions. This creates a death spiral for the stock price, where any good news is just an opportunity to sell more stock, pushing the price back down. This is a capital-intensive transformation in a capital-constrained market. It's the opposite of a company like Nvidia stock, which is a fortress of profitability and cash flow. Nuburu is a house of cards, beautiful in its ambition, but standing on a foundation of $6 million and a lot of press releases. So what does Nuburu, the new Nuburu, actually do? As of today, it is an aspiring holding company. Its business model is no longer B2B hardware sales of lasers. Its new business model is M&A. It is to identify, acquire, and integrate small defense, drone, and SaaS companies. The Maddox JV is a perfect example. Nuburu is contributing capital to gain a controlling interest, hoping that Maddox's next-gen drone technologies will find a market with NATO and allied customers. The Orbit acquisition is for a SaaS platform specializing in operational resilience. The company is essentially building a new portfolio from scratch. The old failed business of blue lasers is at best a tiny R&D segment that might have some intellectual property they can contribute to their new defense partners. At worst, it's a pile of worthless written-off assets. The 17% pop is a bet that this brand new, just assembled management team can succeed in one of the most difficult businesses in the world, defense contracting, while simultaneously integrating multiple small companies and constantly raising capital in the public markets just to survive. Looking forward, what are the possible scenarios? The bull case, the one that the 17% jumpers are betting on, is that they actually pull it off. The expectation is that this drone JV with Maddox is legitimate, that it does land a major contract, and that the 100 million projection by 2028 was conservative. If this company starts posting real, significant revenue from its new defense wing, then 0.40 cents a share will look like an absolute steal. The hope is that one of these acquisitions is a diamond in the rough, and that by using its public stock, Nuburu can roll up a company worth hundreds of millions. The bear case, which is the one supported by the financial history, is far more brutal. The reality is that this transformation is a desperate last-ditch effort. The $6 million in cash runs out by early next year. The new acquisitions burn through that capital and fail to generate meaningful revenue. The drone JV projections turn out to be just as hollow as the original Blue Laser EV battery projections. The company is then forced to do a reverse stock split, say 1-for-50, just to stay listed. This is followed by another and another highly dilutive offering at the new higher price, crushing existing shareholders. Eventually, the company runs out of options, fails to meet its NYSE compliance plan, and is delisted or files for bankruptcy, wiping out all common equity. When you